All right, this is the weekend trading report for January 24th, 2016. Go Broncos. The market remains in bearish volatile conditions. On an annual basis using weekly RSI 14, it improves slightly, still at the lower end of neutral with a score of 40 out of 100. The 10-day NDX improved to the middle of neutral with 64 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average improved to minus 6.21%, so it's still 4.25 into the bear, and that's red bearish, but better. The slope of the 50 is red bearish at minus 0.98%. ADX is still strongly trending to the downside at 34.5. The risk index is the 30-period moving average of the VIX divided by the 10-period. That comes in at a score of 0.85, so it's well into the risk-off territory. Take that score of 0.85, look back against the last 5,000 days, and find the average and the standard deviation. That allows us to compute the risk Z at minus 1.81. So it's 1.81 standard deviations below the long-term average. You can see a 90-day histogram of that indicator here. And I want you to notice that we had a higher high all the way up to 3 sigma, and then a drop to minus 1, minus 1.5, and now down around 2 sigma, and slightly improving. In each of these cases where it goes below 1 standard deviation and then starts working its way up has been synonymous with short-term upside trading opportunities. And so I'm cautiously optimistic with some long side trading here, but I'm still very much an intraday trader right now. I will only hold things overnight if it's market's money at risk, but there is some room for recovery here. Monthly rebalancing is scheduled for 1 February. You can see the current holdings and then the current leaders on the basis of Friday's price in this block. In ETF 2, the theoretical exposure remains at 0%, and the model portfolio itself is at 70% with stops in place. Quick look at the ETF 13 and ETF 32 portfolios using the blended monthly look back. Again, you can see only treasuries are positive on the blend. Latin America, emerging markets continue to be the weakest. In the ETF 32, let's see. Again, most everything is in the red, below their 4-month moving average. And only the defensive plays like consumer staples, utilities, and treasuries are above their 4-month. ETF Max consists of that blended monthly look back at something like 1,000, excuse me, 1,000 ETFs. And you can see the winners on the blend took a major beating this week, and like in the VIX, all these volatility related ETFs had big give backs this week. Still very well on the plus side for 1 month, 3 and 6 months, but you can see just how volatile those rascals are, and the fact that so many of these are below average. That's anything that's in the red or the yellow would be something below average. Just shows you how volatile things have been lately. Of note is this S&P Small Cap Utilities, PSCU, is greens across the board and was positive for the week. So maybe there's some momentum there. A couple others that come to mind like that. The long bond is the long bond bull ETF. That's DBL. Oops, trying to get that highlighter working. There we go. That one at position 32, and these here at 43, 44, and 45. New Zealand, covered bonds, and Treasury 5-year bulls, and then utilities. offer some opportunities there. S&P 500, First Solar had quite a rebound this week. So that would certainly be worth paying attention to intraday, which we will do in the third position. And then your 7 through 11 all had some major wins, like McDonald's, Nvidia. Google had a nice bounce. Campbell Soup, Dollar Tree, and Mattel. So there are some possibilities for early leadership starting to emerge. These are the ones that were paying off this past week, where we had this little bounce. Is it a dead cat bounce? They all look the same starting off. A dead cat bounce that doesn't fail looks like an intermediate bottom in retrospect. So you don't know until that happens. But that's where the early leadership is starting to emerge. And I would pay attention to them just for that reason alone. We'll shift now to the market health check. And we'll just notice, we've got the vertical blue lines are 10, 20, and 30 days worth of look back, and here's the 60-day. You can see the slope of the 30-period regression line, which is what I'm drawing in here. And now that is bottoming out right down here about minus 0.65 on that scale. That's almost 3 sigma steep down, showing some evidence of bottoming here. And so if we get that kind of a move in the slope, we would expect to see the sell-off stop and then start to find support here around this price level. Then this would look like a bottoming tail. And so the last 3 days there was actually some positive rebound and carried over into the weekend. So that has some possibilities for gains. But you can see the 10-period regression channel is down, the 30 is down, the river has rolled over, as we can see. So this is that's what bearish volatile looks like. In ETF 2, the regional market model, everything is in cash position, so that keeps the model at 0% invested and 100% cash in the theoretical model. The S&P is better than EFA. That's on the basis of 60 versus 54. Inside the U.S., technology, then large caps, then mid caps, then small caps. The S&P and then U.S. technology are the two strongest sectors. Two weakest sectors remain Latin America and emerging markets. There's strength down here in utilities and consumer staples. World market model itself. We have all the large caps are above average in the U.S. Mid-cap growth is above average. Everything else below average. Everything in China, or I should say Asia, we got China, Malaysia, South Korea, and Indonesia all above average. Everything else is below average or far below average. Japan showing a little signs of life. Canada and Mexico below average. Brazil way below average, along with Latin America. Everything Europe pretty much weak, except for the growth story. Belgium and Netherlands above average. Everything else looks pretty horrible. Treasuries and corporate bonds continue to look good. Gold and silver have worked their way back above average. Oil and commodities still getting crushed. The ETF top 30. Treasuries have worked their way to the top of that stack with TLT. All of these that are green and white are the emergent leaders on the that have been doing well during the sell-off. So that's going to be all your bond funds and short-term funds. U.S. real estate still hanging in there down here with ICF in the green across the board. Among the Dow industrials, we have Verizon has marched up to the top along with Walmart, and United Health has joined that top 10 with the green and white or the green and yellow. Long-term leaders, McDonald's and Microsoft, continue to do well. Only one symbol now in the red. Last week there were none, and so AXP showing the most weakness with reds on strength and consistency. Shifting to the daily report. I want to look at the Dow 30 Tactical. Quite a few dojis from Friday have showed up on the report. Lots of dojis. A 551W in Walmart, which is attractive. And then half of the Dow showing up on the auto framer on a simple retest of the 10-day average. Couple good frogs with United Tech, Caterpillar, and Coca-Cola. Only one firing on the RSI 2, and that's American Express. You can see just how smashed that has become with red results anywhere from 1 day out to 12 months. Apple showed a little bit of strength on Friday, being up 5%. So a nice payday there. I would look for more follow-through, especially from Apple. In the ETFs, pretty much the same, with lots of dojis appearing, more than half firing on the auto framer, nothing firing on the RSI 2, and then big moves, of course, in the volatility and oil sectors. Lots of symbols to choose from on the auto framer, so I'm not going to read those to you. But DuPont, Goldman, and Brazil among the top 5. And also lots to choose from here on the regression line fractal framework. And the daily squeeze is especially well populated today, and so Friday was a low range day, and there's still a lot of room to the 10-day high, and the range stats are all large, so that gives perfect conditions for using the daily squeeze as a sort of like an auto framer. And so there's some good names on there like Google, Verizon, and the sector spiders for healthcare. NVIDIA is on there as well. So lots to choose from on the daily squeeze. I consider those to be pretty low risk ideas. I'm just going to flash through the backup charts here and see if there's anything worth highlighting. You can see here the big pop in volatility here these last 10 days by every measure. We're almost we're at 3 standard deviations below the long-term average. The last time that happened, that set up conditions for a really nice 10 to 12 point recovery. You'll notice that the negative slope on the 30 period regression line is the 4th worst in the last 10 years. And each one of those was followed by a nice rebound, a nice recovery. So we may see in retrospect that Friday was the day that sort of confirmed that. The Wednesday, Thursday, Friday move of this week was a nice bounce. We'll see if we get some continuation this week. I'm just going to, nothing on these reports of note. This is a natural place to find that support. If you look at that triple bottom, we've got a really nice trading range in here from 210 to 185. That's a 25-point range. That's about a 12%, trading range. So there's room to make money inside of that. I don't really get bullish until I see a close above 210 or 212. And if this holds, that's a failure below 185 is where I pick up a downside orientation. And so now where we are in this location, getting ready to re-enter the widened river, there's room for a nice move just to go up and retest previous highs. So I'm cautiously optimistic about that. I would just say because we're so far below the 200, we're at 4% below, and volatility is high, that I'm still prepared to treat this as a dead cat bounce until proven otherwise, meaning I'm willing to trade it on the long side, but I will only use markets money to risk overnight, and I'm prepared to shift to a downward bias or back to the downward bias in a heartbeat. So I'm basically letting the market decide where I'm going to go intraday. That's everything I want to cover on this weekend. I don't want to overthink it with individual setups. There's a couple that we could think about, like Google, McDonald's, Microsoft, and Apple. But I don't want to get too far away from getting the market call right. I think it's, especially in bears, it's important to get that market call, market direction right, and then that becomes the baseline for building the deeper positions in the in individual sectors and companies. So that's all I have for today. Let you get back to the football game, and I'll be publishing some guidance on the upcoming swing trade workshop for home study here today or tomorrow, and we'll get started on that next week. So take good care, and those of you on the East Coast, try to stay warm and be safe on the roads. That's everything I have. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry. I'll be posting this in the edited version of this in the chat room in about 30 minutes. So cheers.